Money, it's the invisible force that drives nations, shapes economies, and affects every aspect of our lives. But have you ever wondered how the United States built its financial system? From economic triumphs to devastating crashes, from paper money to digital currencies, let's unravel the gripping story of U.S. finance. The birth of American finance, 1780s to 1880s. After gaining independence, the U.S. faced a major financial challenge: enormous war debts. Alexander Hamilton, the first Secretary of the Treasury, introduced the idea of a centralized financial system, leading to the creation of the first Bank of the United States in 1791. This bank helped stabilize currency, manage national debt, and facilitate trade. Not everyone agreed with Hamilton. Thomas Jefferson and his supporters feared the bank gave too much power to the federal government. Their debates laid the foundation for future financial policy battles. The first bank's charter expired in 1811, and though a second bank was created in 1816, President Andrew Jackson dismantled it in the 1830s, leading to an era of unstable banking known as the free banking era. Rise of the stock market and industrial economy, 1800s to 1900s. In 1792, stockbrokers gathered under a buttonwood tree in New York City to form the New York Stock Exchange. Over time, businesses began selling shares to raise capital, fueling industrial expansion and economic growth. The 19th century saw massive industrialization, leading to the rise of powerful corporations like Standard Oil and U.S. Steel. The stock market became a hub of financial activity. But without regulations, speculation and financial bubbles became a problem. The Panic of 1929 and the Great Depression. By the 1920s, stock prices soared, fueled by speculative investments and easy credit. But in October 1929, the market crashed, wiping out fortunes overnight. This marked the beginning of the Great Depression, the worst economic downturn in U.S. history. Banks failed, businesses collapsed, and unemployment reached 25%. The financial system was in shambles. In response, President Franklin D. Roosevelt launched the New Deal, implementing financial safeguards like the FDIC to protect bank deposits and the Securities and Exchange Commission, SEC, to regulate Wall Street. These reforms helped rebuild trust in the system. The rise of the Federal Reserve and modern banking, 1900s to present. To prevent future crises, the Federal Reserve was established in 1913 as the central bank of the U.S. Its job? To regulate money supply, manage interest rates, and stabilize the economy. Over the decades, the Fed has played a crucial role in managing inflation, recessions, and economic growth. The late 20th century saw another transformation. The rise of credit cards, ATMs, and digital banking revolutionized how Americans access and manage money. The 2008 financial crisis and the future of finance. Fast forward to 2008. Financial institutions engaged in reckless lending, approving risky mortgages that people could not afford. When the housing bubble burst, banks collapsed, leading to a financial crisis that spread worldwide. Animation of Congress passing bailout packages and new regulations. The government responded with massive bailouts and regulations like the Dodd-Frank Act to prevent another meltdown. But questions remain: did we fix the root problem? Today, technology is changing finance once again. Cryptocurrencies, blockchain, and fintech companies are reshaping the system. Could this be the future of money? From Alexander Hamilton's vision to the rise of Bitcoin, U.S. finance has seen massive changes. One thing remains certain: money will always shape our world. What do you think the future of finance looks like?